few weeks ago, I travelled to Frankfurt to attend a conference called Sibos. For those of you who haven't heard of it, and there are probably many of you, Sibos is a massive event for the financial services industry organised every year by SWIFT, the global organisation that oversees cross-border bank flows. It's where banks and fund managers and exchanges and clearinghouses get together to talk about the plumbing of the financial system, the unglamorous but important stuff that we tend to take for granted most of the time. Among senior bankers, Sibos has a reputation for being a bit boring. But this year, it was actually a great place to observe one of the most interesting developments in finance, the fight over the future of money. This battle has been going on for a while. Bitcoin has been around for more than a decade and a half. In that time, I've lost count of the number of technologists and entrepreneurs who have told me with great confidence that cryptocurrencies are going to make banks obsolete. Yet recently the debate has become more urgent. The technology that supports cryptocurrencies like Bitcoin, the distributed ledger, also often known as the blockchain, is seeping into the financial mainstream. Meanwhile, Donald Trump's return to the White House spurred Congress to create a regulatory framework in the US for stablecoins. These are the cryptocurrencies exchangeable into a national currency like the dollar and backed by reliable assets like government bonds. This act, the Genius Act as it was called, has turbocharged the market for stablecoins. It has also prompted central banks and politicians around the world to respond. So the stage is set for a battle involving banks, central banks, regulators, and upstart financial institutions to define how money will work in the future. There are big and important questions at stake. How much influence should central banks exert over our money? Can regulators make sure that stablecoins and other forms of private money are safe? Will this technology separate banking from the payment system? So this week on The Big View, we're going to talk about the future of money. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into the biggest questions in finance, business, and economics. I'm your host, Peter Thal Larsen. And this week, I'm delighted to be joined by Felix Martin. Felix is an economist, an investor, and a writer, and a regular columnist for Breaking Views. He's also the author of Money, the Unauthorized Biography, and is therefore an ideal person to guide us through the past, present, future of money. Felix Martin, welcome to The Big View.
Thank you very much, Peter. It's great to be with you.
So, Felix, let's just start with a bit of history, because I think a lot of people that you talk to in the cryptocurrency world tell you that this is all new and different and unprecedented and revolutionary. I just wonder, I mean, you literally wrote a book about the history of money. How do you sort of think about the cryptocurrency, Bitcoin, distributed ledger kind of revolution in the context of the history of money?
I mean, I think that I think in some crucial respects, it's not new, nothing new under the sun. But then again, there are some important technological advances. So, I mean, the way in which crypto in general is not new is that private monies, privately issued monies, that's not new. They've been around forever and ever. There's loads and loads of examples of those. So money does not have to be a creature of the state. It doesn't have to be liabilities of the central bank, for example. Although those are the dominant forms of money in the modern era. And I think when Bitcoin first came out, this would be less true now, but there was another proposed distinction was that it was the world's first virtual money. You know, that hitherto money had always basically been real, and then you might sort of build something digital on top of it, maybe, or paper first and then digital on top of it. But really, you know, its origins were in something real. And that's an important misconception as well. You know, money is and always has been circulating credit. And credit, of course, is something completely insubstantial, virtual. Monetary value is a purely virtual set of ideas. and the types of token that you use to record, represent, and transfer it, those have been extraordinarily varied throughout monetary history. And the latest iterations, digital versions, and so on, they're just another way of doing that same thing. So they're representing the same sort of underlying monetary concept, reality, whatever you want to call it. So those are two things which aren't different about the revolution of the last 10 or 15 years. But then there are things which, of course, are very different. And these have to do with digitization, which has proceeded apace, the availability of very cheap computing power, mobile telephony, I would say, much underappreciated, absolutely crucial part of this whole revolution. The fact that this can all be done on your phone as you're carrying it around, that's very important for real world transactions. And cryptography, of course, the ability to keep things secure. That was another big part of the revolution, and the distributed ledger technology. I mean, that's undoubtedly, that really was the the main underlying innovation from Bitcoin, and that's pretty important and new.
Yeah, the famous blockchain. I guess I wonder why this is all coming back to the fore again so much recently, because I mean, Bitcoin's been around for over 15 years. There was, and has obviously established itself as some sort of speculative asset or something, virtual gold or whatever you want to call it. But a lot of the claims that were made, for Bitcoin as the future of money, haven't really panned out. We obviously had Facebook try to launch its sort of its digital currency, Libra, in 2019. That was a flop. What's your explanation for why suddenly now we're back in this moment where bankers and central bankers and politicians, everybody are sort of obsessing over the future of money again?
Yeah, that's a very interesting question. I mean, I think one can look at it on two levels. I mean, one is just to go back to those technological advances and the the diffusion, the dispersion throughout the economy globally, particularly in the advanced economies, but also in the developing world, of these technologies. And they've all taken a while to percolate through. It's easy to forget that pre-financial crisis there were no iPhones, weren't really many smartphones, and so on. So those big changes in the supporting technologies and their diffusion, that's been incredibly important. And the availability of cheap computing power, because the cryptography relies upon computing power and so on. So those things are obviously one reason, because those things have continued apace. So they're much more widely spread. So it's much easier to, people are more familiar, they can access this kind of thing. I remember when I started, giving talks about Bitcoin, more than a decade ago, I mean, very few people had really heard of it or knew what it was. Now, of course, that's not true at all. So there's that part of it. There's another part of it, which is to ask, what is the underlying, what were the big forces that, that led to a demand for private money on a very large scale? Like I said, there's always been, small constituencies who've wanted to create, for one reason or another, private currencies to escape essentially from the monetary policy of the state national currency. And in many emerging markets, many listeners will be very familiar, there's been a very widespread phenomenon of what's called dollarization, but it just refers actually generally to the use of foreign currencies within a national jurisdiction. Again, because businesses operating, let's say, in a hyperinflationary environment might want to use a more stable currency unit, and therefore they would start to transact in US dollars. That was very common in Latin America, Turkey, places like that. So that's always been around, generally on a small scale or in specific kinds of uses. And I think it's worth asking, relating to your question, where did Bitcoin come out of? We remember it came out of course, the aftermath of the financial crisis. A lot of dissatisfaction with the conventional financial sector, perceptions that it was unfair, that the bailouts had been unfair, that it skewed against the little guy, all this kind of thinking. It also had a strong sort of libertarian or anti-political authority. It was associated with all that kind of stuff. I used to joke that these crypto conferences were the only place you could go where you would meet both sort of very, very left-wing old sort of Marxists and very, very right-wing libertarians. And what they share in common is a distrust of the state politically. So that was another important part of the whole motivation for it. And those sort of feelings, I think, have waxed and waned. They were very powerful immediately after the financial crisis, and so perhaps that's why these things came along in their first incarnation. Then maybe it waned a bit for some years, and then maybe for various reasons it's all come back a bit in the last 5 years. And I think it's important to think about those big picture underlying motivations, because I'm sure we'll come on to stable coins, CBDCs, which are, as it were, the co-option of crypto by central banks and the conventional banking system. And so it's important to think whether they actually satisfy those underlying demands.
But that's co-option is the key word, it seems to me, because that's I was at this big conference called Cybos a couple of weeks ago in Frankfurt, where all these banks and fund managers and clearing houses and exchanges get together and talk about, the sort of the plumbing of the financial system. And what struck me was all these big institutions have now completely embraced distributed ledger technology and the blockchain, and they're all talking about how it affects their businesses. But when you go back to the events that you were talking about with the Marxists and the libertarians, they were imagining a world where all these big institutions had been disrupted, had been replaced, were sort of rendered obsolete. And actually, what you have here seems to me is a situation where the sort of the intermediaries who were supposed to be disintermediated are actually sort of absorbing the technology and using it, but they're still involved.
Yes, I mean, that's undoubtedly true. And there are lots of reasons for it and lots of angles on it. So, what you're getting at is how come this ingenious invention, at the center of which was the blockchain, distributed ledger technology, the distributed nature of it means it's very decentralized, no one controls it, no one owns it, and so on. Why has it ended up collapsing back in large part, or the popular part of it, into this more centralized sort of organization? I think part of that is to do with the fact that it's difficult for everyday retail or business users to get their heads around the tech required to do it in the original fashion. It's some listeners may know this. They may have tried it. They may have tried to set up their own wallets. They may have tried to do all this. It can be done, but it's it's a bit like can you fix your own washing machine or something like that? I'm sure you can if you go through all the steps and you look it up on YouTube and everything. But most people just want a simpler way of accessing these things, and so of course it's notable that crypto in general and Bitcoin and so on and so forth, where it's really taken off amongst an everyday audience, is where centralized and usually regulated, not always, but usually regulated solutions have been made available. So ETFs for Bitcoin, ETFs for crypto, and so on. I mean, another obvious reason for this is that from the regulator's perspective, from national jurisdictions, central banks, financial regulators' perspective, there is a fundamental issue with distributed ledger technology. It doesn't really have a jurisdiction. It's difficult to know who you're going to finger if something goes wrong, and that's pretty important in financial regulation. And therefore, of course, the tendency is to try to set up a regulatory framework, bring onshore those parts of this crypto industry which are currently offshore from major jurisdictions where they're being used, and then to put them under proper regulatory scrutiny and conduct rules and so on and so forth.
Yeah, I like that distinction between the sort of onshore and offshore. It's sort of reminiscent of numbered Swiss bank accounts and secret deposits in Panama and places like that, which in some ways is quite a good analogy to what's been happening in crypto. I mean,
yeah, I mean, Peter, there's of course, I mean, there's a very specific, I mean that actually quite specifically though, in the case of the probably the hottest area of crypto at the moment, stable coins. I think the key thing one of the key things to remember there is that this is an industry, an offering which has taken off and is very widely used. But the single largest issuer of stable coins, the US dollar denominated stable coins, that's the vast majority of all of them. Tether, issuer of the USDT stable coin, this is domiciled in El Salvador. But of course, people can avail themselves of its services all over the world, and that was going on for quite a long time, and it grew to quite a size. And then you had a sort of the second biggest US dollar stablecoin issuer, Circle, that's domiciled in the United States. But it started issuing and operating its stablecoin when there was no specific regulation in place for it. And so what you had is, an onshore unregulated issuance industry. You had an offshore unregulated, semi-regulated industry. And what's changed this year, for example, is that the Trump administration came in, made it very clear that they wanted to set up a regulatory framework for the onshore industry that would regulate Circle and other firms that want to issue stablecoins within the US. And the idea, I think, is to try to tempt and attract the US dollar stablecoin issuance industry back into the states, into a regulated jurisdiction. And the same kind of thing is going on at the moment, in the UK, for example, a bit behind. These things are out for consultation at the moment in the UK. And recently we've heard that the EU, who were previously, or Eurozone, sorry, who were previously averse to the idea of stable coins, they're also moving in that direction. But the idea is, that there is already this industry that's out there. There are already these companies that are running stable coins and issuing them, but they're just not in the jurisdictions where they're mainly being used. And so, of course, those jurisdictions would like to bring the issuance and operation of these things onshore and then to regulate them.
Yeah, and obviously the US has taken a big step there past this act called the Genius Act, which sort of attempts to regulate stablecoins. Should just say, just for clarity, I mean, so with stablecoins, we're talking about sort of digital tokens that are basically backed by and exchangeable into sort of a currency of a country. So in this case, we're talking mostly about dollars, right? So they're essentially it's a digital token that is supposed to be equivalent to a dollar.
Yeah, that's right. I mean, I like to think about this whole crypto world in a simple taxonomy on two axes. So on one axis, you've got whether the money in question has its own standard unit, or whether it has a standard that's pegged to some existing unit. So if you think about conventional currencies that people are familiar with, the own standard ones are regular national, most regular national currencies like the pound, sterling, like the euro, like Japanese yen, like the US dollar. These have their own standard unit, and they don't define that relative to any other monetary unit. They're actually defined usually in all those four cases I just mentioned relative to the growth of the price level. That's how they are in that sense defined. When the central bank issues those and you ask it, well, what's this thing worth? It's telling you via its inflation target that they're undertaking to try at least, to make it worth a given basket of goods and services, or at least that the growth of price of those over time. And the ones with fixed standards, that's different. They are saying, what we are guaranteeing is that the value of this monetary unit relates to some existing monetary unit, and that's where you have traditional pegged currencies. Can't think of one off the top of my. Oh, I can think of one off the top of my head. The Bosnian convertible mark, for example, is in a currency board with the euro, so it's pegged to the euro. Now, it's not a digital currency, it's not a cryptocurrency, it's a conventional national currency, but it's pegged. And CBDCs, for example, central bank digital currencies, or stable coins are both examples of cryptocurrencies, currencies recorded on distributed ledgers, whose standard unit is very specifically tied to an existing national currency. That's only one. So the first axis is that one. Is your standard unit your own one, or is it pegged to someone else's? And the other crucial axis in this whole game of crypto is whether balances are recorded and transfers are made in the conventional national payment system, bank-based payment system in all systems around the world, or in the digitally native, intrinsically international blockchain technology. So that's the other axis. And you can fill in these. So, we mentioned the pound sterling, for example. It's an own standard currency, and it's operated through the conventional national banking system. Bitcoin, that's an example of an own standard cryptocurrency. It's not pegged to anything. Yeah, that's why its value goes up and down so much, going up a lot at the moment. And it operates on the blockchain. So it's in that quadrant there, own standard and on the blockchain. And then if you move over to these fixed standard cryptocurrencies, you've got ones that operate, within the conventional national payments framework. And that's really where CBDCs are. They're intrinsically within national jurisdiction. That's the clue is in the name, central bank digital currencies. There's no world central bank. Central banks are, of course, in national jurisdictions. So they are cryptocurrencies, but they're intrinsically national. And if you want to try and knit them together into something international, have an international CBDC payment system, you have to put together some kind of network of CBDCs. There are some of these around. But then the stablecoins, those are the fixed standard, but they are like Bitcoin they're intrinsically international, they're digitally native, they're not intrinsically linked to conventional banking systems. They're on the blockchain like Bitcoin, 24-hour, 365 days a year, real-time access. Doesn't matter where you are in the world, doesn't matter what jurisdiction you're in, the blockchain is always there for you. So that's the kind of taxonomy that I think of them in.
Yeah, but this then gets to a sort of attention, I think, with stable coins, right? Because the US has passed this regulation to try and sort of bring them into a regulatory framework. And actually in Frankfurt, I heard Christopher Waller, who's a governor of the Federal Reserve and possible future chair of the Federal Reserve, making a very strong argument that says, actually, we believe that the best organizations to develop this new technology are private enterprises, and the role of the Fed and other regulators should be to sort of provide a framework and then stand well back and let entrepreneurs do what they do. But the way you're talking about it does seem like there's a bit of a problem there, because on the one hand you are telling people, here are these tokens that are basically digital dollars, but on the other hand they're provided by private companies, they're backed by assets which are and there are certain regulations about a certain proportion of government bonds and so forth, and they have to be exchangeable, but they're not really, they haven't really been fully tested in a situation where people might worry about the value of their digital tokens, or might try to exchange them for dollars and things like that. So, and it sounds, the way you're describing it, like that tension is almost impossible to resolve. It will always be there to some extent. Is that right?
I'm not so sure about that. I mean, I think that the concerns about the backing of stablecoins. So that's one set of concerns, which I think you were getting at there. This stablecoin says it's worth $1, but what happens when I want to change it into a real dollar? In other words, $1 in my US bank account, or dollar cash. In other words, a liability of the US banking system. That's what I think we're defining as a real dollar, something in the conventional monetary aggregates. What happens when I do that? That's not that different from the regulation of money market funds. It is a question which, in principle anyway, can be resolved via regulation. And the act that's been passed in the US, it requires, I think it's got quite strict rules on what collateral can be held by stablecoin issuers to back their tokens. It is true, of course, that the we live in, I think what makes people very nervous, and rightly so, about the stablecoin phenomenon in this respect is that the scale and speed of the digital world, the possibility for the vast demand that there might in principle be for these things, both nationally and even internationally, should raise some concerns about liquidity and this kind of thing in markets for collateral and so on. But I don't think intrinsically in that respect, this is something which can't be dealt with by regulation, as long as we're talking about onshore issuers in regulated markets, of course. Once you start talking about issuers who are offshore in unregulated markets, that's a different ball game. But I suppose that someone like Waller would probably say, well, people can take their chances. If they want to accept IOUs from someone who's not in our jurisdiction, not subject to our rules and conduct regulation, well, that's good luck to them.
No, I think that's right. I think that's sort of where they come from. But I think there is still an issue there. I mean, you mentioned money market funds, and obviously, I mean, one of the things that I remember very clearly from the 2008 financial crisis was when that big money market fund broke the buck. It was supposed to be worth at least $1, and it was, and because the underlying assets supporting the money market fund had fallen so much that it was no longer worth $1. And there's been quite a lot of changes to the regulation of money market funds to essentially get away from that idea that, like, this is definitely worth $1. And so you can sort of imagine a situation in stablecoins. This is definitely something that some of the regulators, like the people at the Bank for International Settlements, the sort of the central bank in Basel, have worried about, that different stable coins might not all be equally valuable, and might actually their value might fluctuate a bit relative to each other, which undermines the idea of sort of money being completely exchangeable.
Yeah, but I think they're exactly, there's at least three different things that people are worrying about there. So one is this thing about the singularity of money and how important that is. That's a philosophical, practical difference that people have. Some people, maybe, I don't know what Waller's views are. Maybe he's in this camp. Maybe he's not so worried about that. Maybe he says, look, people around the world are perfectly capable of judging between dodgy offshore issuers and safe onshore issuers, and it's not a problem if the dodgy offshore issuer's dollar trades at a discount to the regulated onshore dollar. That's just fine. So there's that question, and I think that is more of a concern for central bankers when they're talking about the domestic financial system than the international one. But of course, there's no clear distinction between that in the digital world. So that's where that comes from. But I think there's a diversity of views on that. There's a diversity of views on the historical, effectiveness and problems of having co-circulating dollars at different discounts and so on and so forth.
I mean, there's one thing I want to get into here a little bit, which is what effect all of this will have or might have on the banking system. So, I mean, it seems like essentially there are broadly three buckets where the sort of the blockchain is the distributed ledger technology is being applied. So there's stable coins, which we talked about. There's central bank digital currencies, which we also talked about, which is the idea of obviously central banks issuing their own digital currencies. And then there's this third idea, which is where banks take bank deposits, but put them on the blockchain, so they're sort of tokenized and then can be moved around. And there's a sort of there's a bit of a contest going on, I think, to sort of see like which of these are going to catch on. But that potentially also has quite a big impact on how the banking system works, doesn't it? Because at the moment, the banking system, the deposits you put in the bank are also are also what you then use for payments. So the payment system and the banking system are very completely intermingled.
Yes, I mean, undoubtedly, again, one of the main concerns I think about regulators, rightly so, about the pace, the speed of this kind of transition, and it has to do with its impact on the structure of the current financial system. As you say, we have a system whereby central bank balance sheets look a certain way. They have a limited range of assets in normal times, anyway, typically just composed of very high quality collateral, usually government bonds and bills. And then the commercial banking system provides credit to the economy, and as you say, the liabilities side of their balance sheet includes deposits which are used as settlements media for payments. And so, one obvious concern, with the growth both of CBDCs, by the way, and stablecoins, insofar as stablecoins were subject to regulation on their collateral, such that it would look rather like the balance sheet of the central bank. In other words, they would be backed entirely with very high quality collateral, government bonds and bills, and so on, and therefore be very safe. Would be that you might see a large scale migration out of commercial bank deposits into stablecoins, or as it might be, central bank digital currency. People would say, well, why not for your transactions balances where you're not worried about earning interest? Another important niggle, which we can come back to. Can you pay interest or not on these things? But let's say that you can't. For transactions balances, where you're not worried about that fact that you're not earning interest, why won't they just all suddenly wash out of the commercial banking system and into CBDCs or stable coins? And then you're left with a huge funding gap for credit in the economy, for mortgages, for business loans, and so on and so forth. And I guess the thinking is that, if this was stable coins we were talking about, how could this be resolved except for the central bank having to then provide liquidity, effectively, indirectly or directly taking on the role of credit creation in the economy? Is that something that we want? I think Andrew Bailey's op-ed last week, maybe it was even this week, in the FT on the subject of stable coins.
Andrew Bailey, the governor of the Bank
Governor
of
the Bank of England, he made an important intervention on this very point. He, like many central bankers, has been rather cautious, I think, about stable coins up till now. On this basis, risks to the structure of the financial system as it stands. And the purpose of that op-ed was to say, look, there's no necessary reason, it is true, why the financial system and the banking system has to be organized exactly as it is today. It's just a historical evolution over time. There's no reason why the particular division of the proportion of credit in the economy, which is provided by banks and is provided by capital markets institutions, is as it is. And the same for government finances. It's just a historical accident, and it changes over time. We've seen it change over the last 10, 15 years with the growth of private credit, for example, credit provided by capital markets institutions rather than by banks. And so I think what he was trying to do was signify an openness to the idea that if a case can be made for the efficiency, benefits for consumers, benefits for the economy of widespread use of stable coins, then one should be a bit tolerant of the fact that this might change the structure of the financial system. It might shift credit creation more towards capital markets institutions and away from the banking sector, and that we shouldn't be sort of afraid of that just for intrinsic reasons. We should judge it on its merits.
Yeah, so there's a fight going on, not just to sort of define the future of money, but also to define the shape of the banking system, really, which is fascinating. There's one thing I just want to get to before we wrap up. There is also a sort of a kind of a geopolitical aspect to all of this, and obviously the US, the US has passed this regulation for stablecoins, but we've also seen Scott Bessent, the US Treasury Secretary, make some quite sort of grandiose claims about how important this innovation is in terms of sort of promulgating the dollar, the idea that you mentioned it, that people in emerging markets who might feel a bit nervous about their local currency, they might want to hold dollars. Well, if there are lots of stable coins around, it's even easier potentially for them to hold stable coins and use them for payments. But also, to the extent that these coins are then backed by dollar denominated assets, particularly government debt, do we then end up with a situation where if they take off, you've suddenly created a whole load of new demand for US government debt? Does it shore up the dollar and save the US government at the same time?
Yes, I mean that's exactly what Scott Bessent is hoping. He's been perfectly explicit about it. And there's the fiscal aspect to it. Will it create demand for collateral, and that collateral being basically U.S. Treasury bills and bonds that'll provide a sort of vast new source of financing for the U.S. federal deficit. And there's the aspect of just the dominance of the dollar unit of account around the world. So there's no doubt that there's a lot to that. Why is it that stablecoins are the form of cryptocurrency that is taking off in a big way? It's because, to go back to what we were saying earlier on, there is already a very large demand for dollars, all around the world, extraterritorially. It's just that it's mainly satisfied for people that can't actually get a dollar bank account in a US bank, which is difficult to do. You need to pass all kinds of, KYC. So it's mainly satisfied by cash. That's why there's such an enormous quantity of US dollar cash circulating outside of the United States. And that is already, by the way, of course, a extremely low cost, zero cost, in fact, form of financing, effectively, indirectly for the US government in the way we're saying, because, that cash is a liability of the Federal Reserve, and the Federal Reserve is holding on the other side of its balance sheet US Treasury bonds and bills. So one word of caution on Bessent's plan is just to point that out. If the digital version of this, which is the stable coins, as it were, is just going to cannibalize that existing demand, then there's not much incremental demand. So Bessent's actually betting on the idea, it's not unreasonable, of course, in today's world, that the demand for a digital dollar, much easier to get hold of, much safer to keep, you don't have to hide it under your mattress, all the rest of it, will be much larger. So there'll be a big incremental demand, and that'll be very positive on the fiscal front. There's another crucial aspect to this, which I think is very much worth mentioning, and it goes back again to something we were talking about earlier in this conversation, to do with onshore regulated issuance of stable coins. Because were this demand for stablecoins to be satisfied by onshore issuers, so these would be, at like Circle at the moment in the US, it's a US company. It would be holding, US treasuries on a balance sheet that's domiciled in the US, and then it would be issuing stablecoins, which for the moment we'll assume do not pay any interest. So all the, that net interest margin is accruing to a balance sheet in the US, available to be taxed in the US, of course. That is very different. And if you imagine those stable coins were then being accumulated by foreign companies or foreign households, foreign companies which are exporting to the US, let's say, and being paid with these US dollar stable coins and not being paid any interest on those US dollar stable coins they're accumulating. That's a very different situation from the current one, in which foreign exporters accumulate dollars and acquire themselves the US Treasury bonds and bills. And as it were, the net interest margin, it's just the interest, obviously, accrues to the foreign owners. What you're doing is you're basically internalizing, bringing back home the net interest margin, the seigniorage, if you like, onto balance sheets in the United States rather than foreign central banks or foreign companies themselves. And so some people think that is one of the motivations behind this whole idea to promote stable coins. It would, of course, depend. What I've just described hinges upon effectively requiring foreign trade to be settled and transacted in stable coins rather than through the conventional banking system as it is now. It hinges upon, in other words, a kind of reversion to the world, effectively, of exchange controls, distinguishing between transactions flows and financial flows with which you buy US dollar assets like the US Treasury bonds and bills, of the sort that existed after the Second World War up until basically the end of the 50s, and which has not existed for a long time. For a very long time, we've not had exchange controls, certainly, and we haven't had capital controls either. It's all fluid. You can earn dollars by exporting through the current account, and then you can go out and buy US dollar financial assets. And of course, that's what these countries which have accumulated lots of reserves have done on a massive, massive scale. And so this plan, which I would say is kind of the more speculative end of the grand strategy of the US. I'm not sure it's exactly what they're thinking, but it's coherent. It hangs together, but it would mean a digitally facilitated, gigantic reversal of sort of financial globalization and free capital markets and lack of capital controls and exchange controls through the back door. So it would certainly be a gigantic volte-face from what we've seen over the last 30 or 40 years.
Yeah, that's fascinating. That's a really intriguing thought. Felix, we could talk for much longer, but we're out of time, so we're going to have to leave it there for now. I suspect we will have plenty of opportunities to come back and talk about this, and I'm sure you'll be writing about aspects of this in your columns for Breaking Views and elsewhere. So, but for now, thanks very much for this really interesting conversation.
Not at all. Thanks very much indeed, Peter.
That is our show this week. Thanks to Felix for that fascinating discussion. And as always, thanks to you for listening. This podcast was produced by Oliver Tasich in London. You can listen to a new episode of The Big View every Tuesday. And don't forget to tune in to our sister show Viewsroom every Thursday, as well as all the other great podcasts from the Reuters team. To get in touch with feedback, questions and ideas, please email us at breakingviews-podcasts@tr.com. That's breakingviews-podcasts@tr.com. And if you liked what you heard, please rate the show and leave us a review. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.